For decades, the economic relationship between the United States and China was a story of growth, factories, trade, investment, and rapid modernization. But in the last 10 years, that story changed. What began as competition evolved into what many now call an economic war, a struggle that spans trade, technology, supply chains, and strategic minerals. This episode will trace that arc, the before and the after, and show how global commerce became a field of geopolitical conflict. After China joined the World Trade Organization in 2001, trade between the two economies exploded. U.S. consumers enjoyed lower prices, multinational companies found cheaper manufacturing, Chinese cities transformed. For a long time, the assumption was simple: deeper economic ties make conflict less likely. Trade was both engine and glue. Council on Foreign Relations, but beneath the headlines, tension simmered over intellectual property, market access, state subsidies, and strategic industries. These tensions were manageable while the economic relationship was mutually beneficial. Then the balance shifted. The turning point came in the 2010s and accelerated after 2018. The U.S. launched tariffs and trade enforcement measures against a broad range of Chinese goods. China retaliated. Washington's concerns expanded beyond trade into technology transfer, national security, and domestic industrial policy. U.S. policymakers began to see reliance on China as strategic vulnerability rather than just an economic choice. United States Trade Representative, at the same time, the U.S. invested in onshoring strategic industries. Laws like the CHIPS Act aimed to rebuild domestic semiconductor capacity, a direct reaction to the realization that advanced chips are as strategic as oil once was. Semiconductors became the front line. The U.S. introduced a series of export controls to block China, ease access to advanced chip-making tools and the most capable AI chips. Those controls were first tightened in October 2022 and were subsequently expanded in the following years, designed to slow China's progress in AI and advanced military applications. Allies coordinated similar measures, amplifying the effect. In late 2024 and into 2025, enforcement intensified. One notable move required Taiwan Semiconductor Manufacturing Company, TSMC, and other suppliers to halt shipments of the most advanced chips destined for certain Chinese customers, a measure that underscored how export controls now reach beyond U.S. firms to shape global supply chains. China's dominance is not just in factories. It controls critical segments of the supply chain for rare earths and minerals essential to modern tech. Everything from EV motors to missile guidance. As trade friction rose, Beijing began to wield that dominance as leverage. In 2024-2025, China moved to restrict exports of select rare earths and related processing technologies, signaling a willingness to weaponize resource control in response to U.S. measures. Analysts warned this could force the West to diversify supply chains more quickly. The economic war today uses a broader toolkit than classic tariffs. The U.S. blacklists companies from critical technologies, restricts investments, and levies targeted tariffs. China retaliates with export curbs, licensing hurdles, and selective bans. Both sides have used financial and regulatory levers, from sanctions to tightened review of foreign investment. The result is a more fragmented global economy, with companies forced to pick sides or build duplicate supply lines. What does this mean for ordinary people and businesses? For manufacturers, it means higher costs and the need to re-engineer supply chains. For tech companies, it causes delays and uncertainty in product roadmaps. For consumers, some goods get pricier. For governments, strategic stocks and domestic industrial policy become urgent priorities. Globally, these measures are reshaping alliances and prompting investment in alternative supplies and domestic capabilities. Every measure carries geopolitical intent. Export controls aim to slow military-grade technology transfer. Rare earth restrictions aim to raise the cost of Western defense and clean energy projects. Tariffs are bargaining chips in wider diplomatic negotiations. The economic war is a form of statecraft, using markets as instruments of national power. So, where does this go? Broadly, 3 scenarios stand out. Managed competition. The U.S. and China accept limited decoupling in sensitive sectors but keep trade in others. A partially balkanized global economy. Intensified rivalry. Escalating controls, more resource blockades, and deeper fragmentation. Costly for businesses and consumers. De-risking and diversification. Accelerated investment by allies in chip fabs, rare earth processing, and supply chain resilience reduces single-source dependence and lowers the stakes over time. Each path has winners and losers. Policymakers and firms are already acting to tilt outcomes towards the third option, though costs will be significant. The economic war between the United States and China is both modern and retro. Modern in its focus on chips, AI, and data. Retro in its use of tariffs, embargoes, and resource blockades. The logic behind it is simple. Economic power is national power. The consequence is more complex, a world where supply chains, technology standards, and even economic alliances are being reshaped. For businesses and citizens alike, understanding this before and after is no longer optional. It's essential. If you found this episode useful, like and subscribe. In the next episode, we'll deep dive into semiconductors, the microchips at the heart of this conflict. See you there.